Hi, this is Jim Pearce, Chief Investment Strategist for Personal Finance, with a weekly video update on Friday, April 12th, 2024. The inflation picture continues to get murkier. It was also simple 3 months ago. Inflation was coming down, the unemployment rate was rising slowly, and the economy was expected to grow at a modest rate. That's changed. 2 days ago, we learned that the Consumer Price Index grew by 0.4% in March and rose 3.5% over the previous 12 months. So here's the press release from the U.S. Bureau of Labor Statistics, and here are the basic categories. All items less food and energy is sometimes referred to as core CPI. The red bar over here on the left that includes all items is sometimes referred to as headline CPI. But nevertheless, you can see these red bars are closer to 4% than they are the Fed's goal of 2%. Now, if you go to the press release here, they give you some more background data and they break the numbers down by category. So I'll include a link to that here in the report. Now, the monthly growth rate was no higher than it was here. Let me go back. Actually, on this page here, the monthly growth rate was no higher than the previous month, but no lower either. The monthly figure for core CPI, which excludes volatile food and energy prices, was the same. However, the trailing 12-month rate was higher for both. In short, it appears that inflation is stuck around 3%, which is not low enough to satisfy the Fed. It's also not what Wall Street wanted to hear. To the extent lower interest rates are necessary for the economy to keep growing, the odds of that happening anytime soon just went down. Although the stock market is slightly lower now than it was 2 days ago, it is holding up remarkably well given the uncertainty surrounding interest rates. So, as we always do, we'll look at a 6-month chart here of the S&P 500. See it bottoming out here the last week of October. A steady rise, but now you're starting to see a hump forming, basically towards the end of March, and then a gradual decline. Now that could be no different, say, than what you see over here, where there was a hump and then it continued to rise. But right now, you can see a short-term trend in place. Now the bond market isn't as sanguine. The yield on the 10-year Treasury note rose to nearly 4.6% this week, its highest level since November. So here we are way over on the right. You see this spike. Now what I'm going to do here, I'm going to go out to 5 years because I want to show you something here about the yield. It's still lower than it was back here in the fall before we started getting some encouraging data points about inflation. But it's now higher than it was back in 2022 when global supply chain disruptions were causing all sorts of havoc in the economy. So a lot of people are comparing it to where it was last fall, but at the same time, it's really got to get back below to where it was 2 years ago for me to feel like the bond market truly believes that everything is going smoothly. Now, another telling sign is the rapid rise in the VIX, the CBO Volatility Index, or Fear Index. 2 weeks ago, and here, let me open up a chart on the VIX so we can see what we're talking about. But 2 weeks ago, just over here, last week of March, you can see the VIX is down around just a little over 12. Now remember, the lower the VIX, the less fear there is in the stock market. Now it's above 17. You see this big spike here. Okay, now that's still lower than it was back here, again in October, but it's still a lot higher than it was just a few weeks ago. So that's another telling sign that Wall Street's getting nervous. An objective view of these data points all points in the same direction. Higher interest rates are probably going to be with us longer than we would like. In that case, the probability of a stock market correction has also gone up. Even if that does happen, even if that doesn't happen, there's not much impetus to drive stocks higher until there's more clarity regarding monetary policy. As an investor, there are a couple of ways you can benefit from this scenario. Income investors that missed out on buying bonds 6 months ago have another chance to lock in higher yields before interest rates start going down again. Growth investors who've been patiently waiting for a stock market correction so they can buy stocks at cheaper prices may soon get their chance. In other words, the big drop in interest rates and rapid rise in stocks that began 5 months ago may have been a false start. That does not mean it was a mistake, only that it was a bit early. As I note on page 2 of the new issue of Personal Finance posted to the website today, we may see another taper tantrum soon. And to repeat myself, I view that as a buying opportunity instead of a reason to sell stocks. That's this week's PF Update. I look forward to talking to you in another week. Thank you.